We already know the SEC was looking into this play because everything, the whole manipulation, which is so obvious coming in this thing, it's out of this world. But with the rules in place and everything, well, they are not that enforced to the full extent. But we have a new development coming that came out today, this Wednesday, and it's actually from the SEC. Well, the trading platform Robinhood could lose a significant revenue source if the SEC moved to ban the controversial payment for order flows, PFOF. This is huge news if this is actually going to happen, because this is actually the main issue in this play and GameStop as well, because our orders are not actually going to where they're supposed to go, where the actual exchange is calculating the share price, which is the result of the supply and the demand. We know people are buying, the retailers are not selling, and we own the float. That's why the share prices keep dropping, especially on low volume days like yesterday, because the hedges continue to do whatever they want to do with the share price. But it doesn't matter because we know that we own this thing. And this is precisely where, if the SEC really goes further with this thing as they are really, presenting it in this article, man, it's game over. Well, first of all, according to the Wall Street Journal on Wednesday, that is today, Robinhood's initial public offering filing revealed that the broker earned up to 81% of its first quarter revenue from payment for order flow, covering stock, options, and crypto. Well, if the filing is supposed to happen for the IPO on Thursday, that is tomorrow, it doesn't look good for them, okay? Especially with the SEC chairman, Gary Gensler, saying that he previously criticized this practice because this is not fair, not only for the retail traders in AMC and GameStop, but for the whole market, okay? And because of this, the SEC is really looking closely into this thing. So meanwhile, Robinhood has stated that any SEC action against payment for order flow, including stringent regulations on outright ban, could negatively impact its business. Payment for order flow is a banned practice in jurisdictions such as Canada and the UK. Given the fact that these are two major stock exchanges in the world, actually London is even bigger than New York Stock Exchange. So if in London and in Canada these practices are not accepted because they are banned, well, the SEC might as well also go ahead and do the exact same thing here in the US. And that will mean game over. That will mean game over, because if our orders cannot be routed to Citadel anymore, well, guess what? The share price will go up, okay? The share price will go so much higher to the point where it will force those shorts to cover, and that's where we win. So at this point, it's still not confirmed, but the SEC is looking into it, and this is definitely something we need to keep a close eye on. Things are getting hot, guys.